Navigating the global investment landscape can seem like a daunting task, but with the right knowledge, it's possible to unlock significant profit from markets as diverse as the United Kingdom, the United States, Canada, and Poland. Each of these countries presents a unique set of opportunities and challenges, shaped by their economic policies, market maturity, and regulatory environments. Understanding these nuances is the first and most critical step towards building a successful international investment portfolio. The key is not just about where you invest, but how you invest. It requires a strategic approach that balances risk with reward, considers long-term growth potential, and aligns with your personal financial goals. Whether you are a seasoned investor looking to diversify or a newcomer eager to explore international markets, this guide will provide a foundational understanding of how to approach investment in these key economies. We will explore the primary investment vehicles, the economic climates, and the strategic considerations you need to make to maximize your returns. From the established financial hubs of London and New York to the rapidly growing markets in Eastern Europe, the opportunities are vast. Let us delve into how you can strategically position yourself to get profit from your investments in the UK, USA, Canada, and Poland. In the United Kingdom, the investment landscape is mature, sophisticated, and deeply integrated with global financial markets. London remains one of the world's foremost financial centers, offering a wide array of investment opportunities. A primary avenue for profit is the stock market, accessible through the London Stock Exchange, LSE. Investing in blue-chip companies listed on the FTSE 100 index can provide stable dividend-paying returns. These are typically large, well-established corporations with a global footprint, making them relatively resilient to localized economic downturns. For investors with a higher risk appetite, the FTSE 250, which comprises mid-cap companies, often presents greater growth potential, as these firms are typically in a more dynamic phase of their expansion. Beyond individual stocks, exchange-traded funds, ETFs and mutual funds offer a way to diversify across the entire UK market, or specific sectors like technology, healthcare, or green energy with a single investment. This diversification is crucial for mitigating risk. Another significant area for investment in the UK is real estate. While London's property market is notoriously expensive, other major cities like Manchester, Birmingham, and Glasgow offer more accessible entry points with strong rental yields and potential for capital appreciation. Real estate investment trusts each provide an alternative way to invest in a portfolio of properties without the need for direct ownership and management. It's also important to consider the UK's tax-efficient investment accounts, such as the Individual Savings Account, ISA, which allows you to invest a certain amount each year without paying tax on the profits. Leveraging these accounts can significantly boost your net returns. Finally, the UK has a burgeoning venture capital and private equity scene, particularly in the tech and fintech sectors. While high-risk early-stage investments in innovative startups can yield exponential returns for those with the capital and risk tolerance, the United States boasts the largest and one of the most dynamic economies in the world, offering an unparalleled range of investment opportunities. The U.S. stock markets, including the New York Stock Exchange, NYSE, and the NASDAQ, are home to giants and disruptive innovators. Investing in the S&P 500 index, which tracks the 500 largest U.S. publicly traded companies, is a common and effective strategy for capturing the broad growth of the American economy. This index has historically delivered strong, long-term returns. For those seeking higher growth, the NASDAQ is heavily weighted towards technology and biotech companies, offering exposure to some of the most innovative firms in the world, such as Apple, Amazon, and Google. As with the UK, ETFs are an extremely popular tool for American investors, allowing for easy diversification across sectors, industries, or even investment styles like growth or value. The U.S. real estate market is vast and varied. Opportunities range from residential properties in growing suburban areas to commercial real estate in bustling urban centers. Depending on the region, investors can focus on rental income, property flipping, or long-term capital appreciation. REITs are also widely available in the U.S., offering a liquid way to invest in large-scale real estate projects. The U.S. is also the global leader in venture capital. Silicon Valley and other tech hubs like Austin and Boston are epicenters of innovation. And investing in venture capital funds that back the next generation of startups can be incredibly lucrative. Though it is a higher risk endeavor, best suited for sophisticated investors. Furthermore, the U.S. bond market is the largest in the world, offering a range of options from ultra-safe U.S. Treasury bonds, considered a global safe haven asset, to higher-yield corporate bonds. These can be a crucial component of a balanced portfolio, providing stability and income to offset the volatility of the stock market. Canada offers a unique investment proposition, combining the stability of a developed G7 economy with significant exposure to the global commodities cycle. Its economy is rich in natural resources, including oil, gas, minerals, and timber. This makes the Toronto Stock Exchange, TSX, a prime venue for investors looking to gain exposure to the energy and materials sectors. The S&P/TSX Composite Index is heavily influenced by these resource-based companies, and their performance is often tied to global commodity prices. This can lead to periods of significant growth, but also introduces a level of cyclical volatility that investors must be prepared for. Beyond commodities, Canada has a robust financial sector, with its Big Five banks being renowned for their stability and consistent dividend payouts, making them a cornerstone of many Canadian investment portfolios. The Canadian real estate market, particularly in major cities like Toronto and Vancouver, has seen dramatic appreciation over the past few decades. While this has created affordability challenges, it has also generated substantial wealth for property owners and real estate investors. For those looking for alternatives to direct ownership, Canadian REITs offer exposure to residential, commercial, and industrial properties across the country. In recent years, Canada has also been fostering a growing technology sector, particularly in areas like artificial intelligence, clean tech, and e-commerce. Cities like Toronto, Montreal, and Waterloo have become vibrant tech hubs, creating new opportunities for growth-oriented investors. To encourage investment, the Canadian government offers tax-advantaged accounts like the Tax-Free Savings Account, TFSA, and the Registered Retirement Savings Plan, RRSP. The TFSA is particularly powerful, as all investment, income, and capital gains earned within the account are completely tax-free, making it an exceptional tool for wealth creation. Investing in Canada requires an understanding of its economic link to the United States, its largest trading partner, as well as its sensitivity to global demand for natural resources. A well-diversified Canadian portfolio might include a mix of stable financial stocks, resource companies, and emerging tech firms, balanced with real estate and fixed-income assets. Poland stands out as one of Europe's most dynamic and fastest-growing economies, offering a compelling case for investors seeking growth in an emerging market within the stable framework of the European Union. As a major beneficiary of EU structural funds and foreign direct investment, Poland has undergone a remarkable economic transformation over the past 3 decades. The Warsaw Stock Exchange, WSE, is the largest in Central and Eastern Europe, providing a platform to invest in a diverse range of Polish companies. Key sectors include banking, utilities, and consumer goods. However, the most exciting opportunities often lie in Poland's burgeoning technology and gaming industries. The country has become a global powerhouse in video game development, with companies like CD Projekt Red gaining international acclaim. Investing in these innovative, export-oriented companies can offer significant growth potential that is less correlated with the domestic economy. Another major area of opportunity is real estate. Rapid urbanization, rising wages, and a growing middle class have fueled strong demand for residential and commercial properties in major cities like Warsaw, Krakow, and Rock. Rental yields are often higher than in Western European markets, and there is still significant potential for capital appreciation as the economy continues to develop. The industrial and logistics sector is also booming. driven by Poland's strategic location as a logistics hub for Europe. Investing in warehouses and distribution centers, either directly or through specialized funds, can be a profitable strategy. While Poland is part of the EU, it is not yet in the Eurozone, meaning investors must be mindful of currency risk associated with the Polish zloty, PLN. However, this also gives the Polish central bank more flexibility in setting monetary policy to suit local economic conditions. For foreign investors, ETFs that track the WIG20 index, the index of the 20 largest companies on the WSE, or funds focused on Central and Eastern Europe, can provide a simplified way to gain exposure to the Polish market. As with any emerging market, investing in Poland carries higher risk than in the UK or US, but it also offers the potential for superior returns for those willing to do their due diligence and take a long-term perspective on the country's impressive growth story. In conclusion, achieving profit from investment in the UK, USA, Canada, and Poland requires a tailored strategy that acknowledges the distinct economic character of each nation. There is no one-size-fits-all solution. Success hinges on your ability to align your investment choices with the specific market dynamics at play. In the mature markets of the UK and the USA, the focus might be on leveraging sophisticated financial products, diversifying across established blue-chip stocks and broad market ETFs, and utilizing powerful tax-advantaged accounts to maximize net returns. In resource-rich Canada, a profitable approach involves balancing the cyclical nature of its commodity sectors with the stability of its financial institutions and the growth potential of its burgeoning tech scene. Meanwhile, in a dynamic, emerging market like Poland, the pursuit of profit is geared towards capturing rapid growth, particularly in its world-class tech and gaming sectors and its booming real estate market, while carefully managing the associated risks. Ultimately, the pathway to profit is paved with thorough research, strategic diversification, and a long-term perspective. By understanding the unique opportunities and risks inherent in each of these countries, you can construct a robust and profitable international investment portfolio. The journey of global investing is continuous, requiring ongoing education and adaptation, but the potential rewards for those who navigate it wisely are substantial. How to get profit from investment in UK, USA, Canada, Poland, etc. is not a question with a single answer, but a strategic puzzle that you can solve with the right knowledge and approach.